We've got a divergence set up. Recession odds are climbing fast, yet markets are pushing higher. Is this bounce in the S&P 500 the real deal, or another leg down still in play? Let's take a look at these charts and discuss the technicals. S&P 500 yesterday had a big update, and the big question many are asking, was that a meaningful turn that actually has resumed the bull phase, or is there more selling to come? Well, we're actually at a very critical technical level. So I'm going to show here quickly on a 4-hour chart, just to observe that the entire rally was just a 61.8 retrace of the decline. Now, often market corrections come in zigzag formations, which is they have two waves down. And so another leg or decline is still very much potentially on the table. Now, if the as a, from the rules of symmetry, if there was of equal length, then we're talking about a decline potentially as low as 61.50 on the downside. The interesting thing about a correction of that magnitude would be that that would be the exact 5% type market correction. Also, when we go on the daily charts, that would essentially be a direct retest of that 50-day moving average. So at this moment, we are not yet back into a bull phase. Now, what would make it short term bullish? Well, that would be a clearing of the 6,400 level, because then at that moment, this is no longer a fib retracement. And at that stage, a market going for a full double top retest, or even putting in, let's say, the head of a head and shoulders pattern and breaking up to 6,500 are all plausible scenarios. The interesting part is that the NASDAQ, which had a much higher percentage return yesterday, is actually the same technical setup. So if you look here on a 4-hour chart, the entire bounce was simply a Fibonacci retrace of the prior decline. Point being here that on all of these markets, they're not out of the woods yet for another leg down. Point though is that, is this going to be a crash or just one of these market corrections? And I'll stand by my view that at least initially, that this is most likely just a market correction in the process of developing a topping formation. I would always like to compare that to the topping formations that developed in the market in December and January of last year. Notice how numerous times the market hit the 50-day moving average, rallied back towards its highs, and stayed far more range bound. This is at least the most likely scenario for the month of August. Now, eventually, some catalyst could emerge that could spur a bigger market move. On balance of probabilities, that even if we did end up actually having a correction down to the 50-day, odds are the market will likely be testing these level over the next couple of weeks numerous times before we have some more ominous market drop that could happen in the seasonally weak period of September and October. Now, here I want to move on to the dollar and rates. Now, the dollar has found support as well, right at the 50-day moving average, right at its fib zone. Now, the big drop came on that jobs number on Friday, but the puzzle to solve is, did we transition into a new phase where the US dollar is being bought on dip? And this has now met the criteria of a dip. So will today's green candle up 26 cents be the beginning of the dollar rallying back up to 100 and staying north of 100 on this chart? That would certainly be a really good tell, as we have not seen any sustained price action above the 50-day moving average in 6 months. And so this turning here and turning bullish is still on the table. What would make us a short-term bearish? It would have to be a complete wipeout of the previous rally. Whenever you have a fake out, it is basically a breakout attempt that completely gets wiped out. And this is why determining whether the buy on dip traders are going to work here is so critical. Because if the dollar got all the way back down to its previous lows and sustained below the 50-day moving average, then all sorts of the bear continuation patterns would almost instantly come into play. So we're at a very important inflection point along this 50-day. First attempts to buy it here make a whole lot of sense, but you have to have it on a very tight leash to see whether or not this is in fact that key turning point. But what I do want to talk about is where we had the really big move, and that's in the rates markets. Starting off here, this is the December 2025 SOFR futures, which is talking about short-term rates anticipated into the end of the year. What we can see is with that jobs numbers miss, we basically had an extraordinary rip higher, basically pricing in 25 basis points more of cuts. Now, the recession odds have increased. You can see here, Numera now has 33% odds of a 4 or greater cuts coming, which is actually a very good sign of a hard landing scenario. And so the market is starting to price in a scenario that could involve a recession emerging here as well. When we go and look at interest rates out to December of 2026 using the SOFR futures, again, about a 25 basis point jump and a potential breakout. Will we see the market start to price in a much more dovish Fed, particularly since we know that it's very likely that Trump will be replacing Powell early next year? So let's move on to gold. So here, I just want to highlight that gold bounced no different than so many of the other assets in our broader intermarket analysis. It's done a 61.8 retrace to the upside, and its correlation to the inverse correlation to the dollar is very likely to persist. So are we going to see gold attempt something bullish here, or will it break down? I feel the dollar is going to play a very big role in that. So we're going to see which way that breaks. The one thing I'd like to observe is the fact that if gold broke out bullishly, it measures all the way to 3,800 to 4,000. So there's plenty of money to be made if this thing can resolve itself on the upside. And if we go into a broader correction mode, and this is a much broader distribution cycle, then a retracement all the way down to 3,000, which would be about a 61.8 retrace of the prior rally, would certainly be something that's not out of the realm of impossibility. Which way we break out of this consolidation pattern is definitely going to be the thing to watch. So the key takeaway: don't trust this market rally just yet, but at the same time, don't be scared of a big market crash just yet. At this moment, one more dip to the downside in the markets is something that would be very natural and very likely a short-term tactical trading opportunity for a rise back up to the highs. Overall, though, we had an extraordinary bull run where over 4+ months we have run 30+% on the upside of the markets. It's a long overdue for a breather, and we are going into a seasonally weak period in this market. So this is where you have to curtail your enthusiasm about how much upside's left in this market at this stage of the cycle.